In this video, I would like to highlight 10 common pitfalls of investing in blue chip stocks. Investing in blue chip stocks has its advantage, but there are also potential pitfalls to be aware of. Here are 10 common pitfalls that are associated with investing in blue chip stocks. Number one, limited growth potentials. Blue chip stocks often offer stable but modest growth, which may not be as high as smaller growth-oriented stocks. Compared to growth stocks, blue chip stocks provides a level of growth, but it isn't as high as what is expected from a typical small growth-oriented stocks. So that particular growth potential is limited in these regards. Number two, overvaluation risk. There's always a risk of a blue chip stocks getting overvalued because blue chip stocks are very popular. They can become overvalued, which might lead to lower returns or even losses whenever there's a correction in price. We need to understand that usually we make money when we buy, not necessarily when we sell. So if you buy at a higher price, even if you make money, it will not be as much as what you will obtain if you had bought at a lower price. So in this case, whenever there's that particular valuation in a typical blue chip stock and you get to buy it at that overvalued price, even when you sell, you will not make as much money as could be made, assuming you bought at a cheaper rate. And that's why you must be very, very cautious of the fact that blue chip stocks could be overvalued because of their popularity and because they are very attractive to both analysts and investors alike. Number three, market dependency. Even blue chip stocks can be affected by broader market downturns or economic recessions, though they may not be as affected as other classes of stocks, but they are somewhat resilient, more resilient than smaller companies. But all the same, they are equally, affected or influenced by the overall market or economic condition. We should have that at the back of our mind. They are not completely immune from market dependency. No, that isn't the fact. They are, but they are not as affected or as influenced as other smaller stocks, smaller cap stocks in the market. Number four, dividend dependency. Reliance on dividends for income can be risky if the company faces difficult financial times or if the entire economy is on a downturn. So a company may decide not to pay dividends because of the lower than expected return, lower than expected result, or even a loss. If the company incurs a loss, then definitely it's going to affect its dividend payout. It can suspend dividends, it can curtail the level of dividend payout, but all the same, dividends will be affected. So if an investor is so dependent, is so reliant on dividends, it will certainly affect the level of return the individual is going to get. Number five, lack of innovation. Lack of innovation. Established blue chip companies might be less innovative compared to newer companies, potentially missing out on the market's emerging trend or on emerging market trends, as the case may be. So these classes of companies are so kind of matured, they are stable, they are kind of, should I say, complacent in the sense that they are not as innovative as expected compared to newer tech companies, biotech companies, and upcoming companies in the market. So that innovation is relatively lacking. They lack innovative dynamics, in the market compared to other upcoming smaller companies. Number six, lower volatility benefit. Lower volatility benefit. While lower volatility can be a benefit, It also means that blue chip stocks might not experience the same rapid gain as more volatile stocks. When you talk about volatility, it is like a two-edged sword. When a stock is rising up as a result of it being volatile, you make money as a momentum investor. If the volatility is dragging the stock price down, like in the case of you would end up losing money. Okay, so because blue chip stocks are kind of stable in the sense that they're not as volatile. The matter is just that they will not make as much money as expected of them compared to other companies that have a higher level of beta. So they have lower beta, and then they are not that volatile. And whenever the stock price is higher as a result of volatility, these blue chip stocks don't get to participate. Number 7, high entry price. Blue chip stocks are often more expensive. Relatively, they are very expensive, which can be a barrier to entry for some investors and may limit potential returns. You don't find these companies at a cheaper rate. That's just the rule of thumb, kind of. You don't find them at a cheaper rate. They are usually very expensive because they are popular. They have numerous analysts following, and you hardly come across inefficiency in their stock prices at all. So they're always very high. And when you buy at a very expensive price, then definitely it's going to affect you at the end of the day when you come to sell. Number 8, company specific risk. Despite their stability, which of course we've highlighted time without number, blue chip companies can face unique risk such as management issues, regulatory changes, or operational challenges. Some of them operate in different countries, and so they may come across country-specific risk. They may equally come across country-specific risk. But all the same, these risks are there, and we should consider this risk when we want to invest in blue chip stocks. Please give me a thumbs up and subscribe to this channel. It will do me a ton of good. Number 9, complacency risk. The perception of safety might lead to complacency, causing investors to overlook changes in the company's fundamentals or market conditions. These companies are known to be stable, they are known to be safe, but that safety tends to bring complacency. You don't react to the changing environment as fast as other companies are reacting to. And so for that reason, sometimes their fundamentals may be decreasing, and then it becomes a problem altogether. When there is diminishing fundamentals, when there is a problem with the balance sheet, that particular complacency can breed this kind of phenomenon in the company's result. Number 10, limited diversification. Investing heavily in blue chip stocks alone may result in a lack of diversification, which could result in an increased risk if the sector or industry faces challenges. And so if you are fully invested in only blue chip stocks without diversifying the cyclical into defensive, into value, into penny or silver stocks, then of course you are not adequately diversified. And so if the sector in which the blue chip stocks are operating face a kind of problems, then of course it's going to affect your investment at the end of the day. And so being aware of these potential pitfalls can help you make more informed investment decisions and balance your portfolio effectively. Blue chip stocks are wonderful, they are good, but we should not neglect to consider these pitfalls, these disadvantages, these drawbacks I've just highlighted in the course of this video.